If you look at the strength of the underlying economy, once again, we have arguably we're at an academic definition of full employment, wages moderately rising, a confident consumer that spent pretty aggressively during the holiday shopping season.
But the economy is slowing, isn't it? Growing but slowing.
Yes, I think that's the theme for the new year. And I think, earnings growth rates will slow. I think economic growth rates will slow, but they're still growing. And if we get a more dovish Fed as a result of that slowing, that could be constructive for stocks in the new year.
Lisa, how about you? Do you see it that way? Do you see it as maybe stacking up as a better year than 2018 was?
Well, we're constructive on the U.S. economy for many of the same reasons that Kevin talked about, and that should be positive for equities. As we look at our economic dashboard, the majority are actually still in positive territory, indicating continued growth. And while that rate of change is slowing, again, when we look at the overall picture, it is a solid one. In addition, you've got a nice number on corporate earnings. Again, while it's not going to be at the same pace as it was in 2018, it's still at a very healthy 7.8% projected for the S&P in 2019, which is very good given that the fact that the tax cuts have run off. And on top of that, now you have some valuations that are more compelling. So factoring in as of the end of yesterday, it was around 16 times trailing 12-month earnings versus a historical 25-year average of around 19.2. So you've got some nice conditions in store for equities. That being said, we are keeping an eye on some of the ongoing issues. As you do note, there are some indicators that are decelerating, so we're continuing to watch that pace in the first quarter as the economic data continues to come out and as first quarter corporate earnings report.
How do you think about earnings, though? Because wasn't Apple sort of the rude awakening to Wall Street, signaling that, earnings estimates might have to really come down in a magnitude that people weren't expecting? I mean, how do you think about earnings estimates and how they should be revised?
Because there's a lot of companies beyond Apple that do a lot of business. Caterpillar, General Motors, Boeing, they all sell into that market big time.
Yeah, and I think some of the issues are Apple-specific, as the previous guest alluded to, but I think it does highlight three of the major headwinds facing the markets right now. Tariffs in U.S.-China trade negotiations, as we spoke about ad nauseum, a strengthening U.S. dollar, which could be affected by what the Fed does or doesn't do in 2019, and of course, the pace of global economic growth. However, I think Apple's warning, in addition to the last two data reports we've gotten out of China and the U.S. today, may bring those two parties together, and perhaps we'll see some form of a trade agreement in the first quarter of 2019, and that could certainly help propel the stock market.
So, Lisa, do I want to, if I am a buyer of individual companies, do I want to lean towards individual companies that do most of their business here in the United States and stay away from the big multinationals that might be exposed either to trade tensions or a global slowdown?
Well, in the longer term, we continue to believe actually that the best place to focus your equity assets is really in terms of the technology industry, notwithstanding some of the Apple profit warnings, and also an area like consumer discretionary. And the reason for that is if you move past some of the risk-off sentiment that is currently dominating the market and favoring more defensive sectors, these two sectors actually have a number of nice top-down trends that are supporting them. You've got the switch to, cloud computing, anywhere, anytime spending, increased use of technology, those kinds of things. So those companies that are able to shift on to those bigger picture themes really have a tailwind at their back. In addition, you have a number of individual industries and companies within that that are known as disruptors and able to take advantage of change and earn very nice returns on capital. So again, for the longer term, we would really see those as areas to park your money.